This island is called Antigua. It sits in the eastern Caribbean, roughly 1,700 miles southeast of Miami. Population, approximately 100,000 people. And for nearly 2 decades, the base of operations for the largest offshore bank fraud in American history. A man named Alan Stanford told 30,000 investors in 113 countries that their money was sitting safely in his bank on this island, earning guaranteed returns of up to 15% per year. He told them this for 19 years. According to the Securities and Exchange Commission, Stanford collected approximately $7.2 billion from those investors between 1990 and 2009. When federal investigators gained access to the books, they found personal loans to Stanford himself, illiquid real estate that couldn't be sold, a regulatory apparatus that had been, according to criminal trial testimony, receiving payments from Stanford in exchange for not looking too closely. The actual recoverable assets, approximately $500 million, against $7.2 billion in claims. When federal agents arrested Alan Stanford at a golf course in Fredericksburg, Virginia on June 18, 2009, they had been receiving credible allegations of fraud since 1997, 12 years. $7.2 billion, 30,000 people, 7 cents recovered for every dollar lost. This episode is not just about Alan Stanford. It is about how a fraud of this scale is built, how real estate is used to manufacture legitimacy, how offshore structure defeats oversight, and how the people who were supposed to catch this failed to do so for over a decade. Because the techniques Stanford used are not unique to Stanford. They are a template, and understanding them is how you recognize them. Before we get to the fraud itself, let's understand who Alan Stanford was and how he positioned himself to run this for 19 years. Alan Stanford was born in 1950 in Mexia, Texas. His first significant business venture was not banking. It was fitness centers, a chain of gyms in the Houston area that ultimately failed. According to Bloomberg reporting and court documents from his criminal trial, Stanford filed for personal bankruptcy in 1984. He was 34 years old. In the mid-1980s, after the bankruptcy, Stanford pivoted to real estate, working the Houston market in a city coming off its own oil-driven collapse. It was in that period that he developed the central idea of everything he built afterward. Real estate creates trust. A building says, "This is real. It was constructed. It exists. You can stand in front of it." In 1985, Stanford moved to Montserrat, a small British territory in the Caribbean, and established his first offshore bank, Guardian International Bank. He sold certificates of deposit. He built a small client base. Montserrat's regulators shut it down in 1990 amid concerns about its operations. Stanford moved again. He chose Antigua, a larger island, a more established offshore sector, and a government that was, Stanford had concluded, more amenable to the kind of relationships he intended to cultivate. He established Stanford International Bank and began the operation that would run for 19 years. To understand how Stanford sustained this fraud for nearly 2 decades, you need to understand how a Ponzi scheme works at a structural level. Because most people know the simplified version, and the simplified version doesn't explain the longevity. The basic structure: a fraudster promises above-market returns. Investors put money in. The fraudster does not invest it as promised. He pays early investors their returns using money from new investors, and pockets the rest for personal use and for maintaining the apparatus that keeps new investors coming. As long as new money comes in faster than withdrawals go out, the scheme sustains itself. The moment that reverses, it collapses. This structure was named after Charles Ponzi, who ran a version of it in Boston in 1920. His scheme lasted 8 months. Stanford's lasted 19 years. The difference is in the architecture. Here is the core problem every Ponzi operator faces. Investors are not stupid. They ask questions. They want evidence that the money is real, that there are actual assets behind the promise. Stanford's answer to that problem was physical. He built things. Stanford International Bank was housed in a purpose-built facility in St. John's, Antigua, not rented office space. A bank building with vaults, with staff, with a government charter on the wall. When an investor flew to Antigua to conduct due diligence, and many did, They saw a bank, a real physical institution, with employees, with a building, with a license. His U.S. headquarters occupied prime space in Houston's Galleria district. According to SEC enforcement filings, he operated brokerage offices in 29 U.S. states, plus offices in Caracas, Bogota, Mexico City, London, and Geneva. Every office followed the same standard: marble lobbies, expensive furniture, framed credentials. The physical environment communicated in every location the same thing: this is a serious institution. Your money is in serious hands. Then there was the cricket stadium. Stanford rebuilt the Antiguan National Stadium from the ground up, a $28 million project according to trial documentation, and renamed it the Sir Vivian Richards Stadium. In 2008, he organized a $20 million winner-take-all match between a Stanford All-Stars team and England's national cricket team. It was broadcast internationally. Stanford stood at the boundary holding a plexiglass box containing $20 million in cash. Think carefully about what that image communicated. A man, at the boundary of a stadium he built, holding $20 million in cash, on international television, with England's national team on the field. This was not a publicity stunt. This was the culmination of a decade of image construction. The stadium said, "I built this." The match said, "I have more money than I know what to do with." The cash box said, "It is real, visible, and here." The entire apparatus, the bank building, the offices, the stadium, the airstrip, existed to answer the due diligence question before it was asked. If you visited Antigua and saw what Stanford had built, you did not leave asking whether his money was real. You left confirming it. That is the function real estate served in this fraud. Not as an investment, as proved. Stanford's product was straightforward. Certificates of deposit issued by Stanford International Bank, an offshore institution in Antigua outside the direct jurisdiction of U.S. financial regulators. He claimed the CDs were backed by a diversified portfolio of stocks, bonds, and real estate, managed by a team of 20 professional analysts. The returns promised between 10 and 15% annually. For context, U.S. Treasury bonds at the same time were yielding under 5%. Stanford explained the difference through offshore advantages: lower overhead, favorable tax treatment, proprietary strategies. The explanation was plausible. Combined with the physical evidence of legitimacy, it worked. By 2008, Stanford had collected approximately $7.2 billion in outstanding CD obligations from investors across 113 countries. Now let's look at what was actually behind the promise. Stanford told investors their $7.2 billion was held in a diversified, liquid portfolio. When federal investigators gained access to the actual books, according to criminal trial evidence presented in U.S. District Court for the Southern District of Texas in 2012, this is what they found. Approximately $2 billion, roughly 28% of investor funds, had been loaned directly to Stanford himself. Personal loans to the founder, secured against Stanford's own real estate holdings, undisclosed to investors. The next largest category, illiquid real estate and private equity, the Antiguan bank building, the airstrip, development properties, partial stakes in private companies, assets that could not be quickly sold, assets whose internal valuations, according to receiver appraisals, were significantly above what they could actually fetch on the open market. What remained in liquid, verifiable financial instruments was a fraction. According to receiver Ralph Janvi's report filed with the court in 2010, total recoverable assets, approximately $500 million. Against $7.2 billion in claims, roughly 7 cents on the dollar. Now, let's examine how this operated, because this is where the case becomes a lesson. Real estate served Stanford in two distinct ways. Both ways appear in virtually every large-scale fraud with a real estate component. Function 1. Real estate as legitimacy performance. When an investor evaluates a financial product, a CD, a fund, a bond, they are evaluating something abstract. Numbers on a document, promised returns, portfolio descriptions. All of these can be fabricated. which is why the best designed frauds include something that cannot be fabricated, something physical. A 2011 paper published in the Journal of Financial Crime analyzed 94 large-scale investment fraud cases and found that frauds with significant real estate holdings consistently achieved higher per-investor losses than those without, not because real estate made the fraud more profitable, but because it made investors more confident, leading them to invest more and withdraw less. Stanford had to spend stolen money on the very apparatus that convinced investors their funds were safe. Function 2. Real estate as a liquidity barrier. In any Ponzi scheme, the fraudster faces continuous pressure between investors wanting their money back and the actual assets that exist to pay them, which are always less than what is owed. Real estate helps slow this, automatically. A bank account can be emptied in minutes. A stock portfolio can be liquidated in a day. A real estate portfolio spanning multiple countries, multiple asset types, and partially completed developments cannot be liquidated quickly. If regulators move against Stanford, if investors demand mass redemptions, the real estate does not move. It takes months, sometimes years, to appraise, to litigate, to find buyers, to close. According to testimony by former Stanford CFO James Davis, who pleaded guilty in 2009 and cooperated with prosecutors, Stanford had explicitly directed funds into illiquid real estate, knowing these assets would be difficult for regulators to quickly recover. That decision was deliberate. Every dollar locked in an Antiguan property was a dollar that bought time. Now, the regulatory failure. Because this element of the case is as important as the fraud itself, in March 2012, the SEC's own Inspector General, the agency's internal watchdog, published a 150-page investigation into how the SEC had handled the Stanford case. The findings were damaging. The Fort Worth Regional Office had first received substantive fraud allegations from a former employee in 1997. The examiner opened an investigation. He found evidence suggesting Stanford was, in his own words, probably a Ponzi scheme. He recommended formal enforcement. His recommendation was overruled. The investigation was closed. It was reopened in 2002. Again, credible evidence. Again, escalation recommended. Again, overruled. The OIG report documented this pattern across multiple investigations over 12 years. It also documented that the examiner responsible for the Stanford case had, at various points, sought employment with Stanford's firm while the investigation was active. The OIG does not reach a definitive conclusion on his motivations, but it documents the conflict of interest precisely. And there is a second reason the SEC failed, one that is the same reason investors failed. Stanford's operation looked real. The OIG report noted that the examiner had expressed doubt Stanford could be running a Ponzi scheme because the firm was too sophisticated and too large. The physical apparatus of legitimacy had worked on the regulator the same way it had worked on investors. The offshore structure requires its own examination. Stanford's CDs were issued by a bank chartered in Antigua, not in the United States. U.S. bank deposits are FDIC insured and subject to direct federal examination. Stanford's CDs were offshore, subject to Antiguan regulation, not U.S. regulation. The SEC has jurisdiction over securities sold to U.S. investors, including offshore products marketed in America. But enforcement across international jurisdictions requires cooperation between regulatory bodies. Stanford's structure was designed to maximize the friction in that cooperation. The bank was in Antigua. The investment records were in Antigua. The auditor, a two-person accounting firm also in Antigua, was the only entity with direct access to verify asset claims. According to the SEC's complaint, that auditor, CAS Hewlett & Associates, had never independently verified the existence or valuation of the portfolio. And the Antiguan financial regulator that was supposed to provide oversight of Stanford International Bank? According to criminal testimony by former FSRIC Deputy Director Leroy King, who pleaded guilty to obstruction charges in 2019, King had accepted over $100,000 in payments from Stanford in exchange for sharing confidential regulatory information and undermining the SEC's attempts to obtain documents. Every layer of oversight that should have caught this fraud had been neutralized, circumvented, or compromised. The U.S. regulator had information and didn't act. The Antiguan regulator was being paid. The auditor wasn't auditing. The fraud ran for 19 years. The collapse came not because a regulator finally acted, but because of an event outside anyone's control. In September 2008, the global financial crisis. Lehman Brothers collapsed. Markets seized. Investors worldwide began demanding redemptions from every institution they were exposed to. Stanford's investors were no different. Withdrawals flooded in. The illiquid real estate and personal loans that made up the actual asset base could not be converted to cash fast enough. The gap between what was owed and what existed could no longer be papered over with new investor money. In February 2009, the SEC filed an emergency enforcement action. Federal agents froze Stanford's accounts. Receivers were appointed, offices were locked, employees arrived for work and found federal notices taped to the glass doors. On June 18, 2009, Stanford was arrested. The human cost of the Stanford fraud is harder to quantify than most financial crimes, because so much of it was absorbed quietly in countries where this story received little sustained coverage. Let's go through the geography. In the United States, Florida, Texas, and Louisiana had the highest concentration of victims. According to the Stanford Victims Coalition, U.S. investors accounted for approximately $1.5 billion of the total $7.2 billion in losses. Many were retirement age. Their CDs were held in IRAs, in pension rollovers, in savings accumulated over decades of work. Venezuela had the single largest concentration of Stanford victims outside the United States. According to the Stanford Victims Coalition and Bloomberg reporting, Venezuelan investors held an estimated $2 billion or more in Stanford CDs. Throughout the 1990s and 2000s, Venezuela was experiencing severe instability, inflation, currency controls, and nationalization of private assets under the Chavez government. Wealthy Venezuelans were actively seeking dollar-denominated accounts outside the reach of their own government. Stanford International Bank was positioned as exactly that solution. When the fraud collapsed, Venezuelan investors lost an estimated $2 billion with almost no prospect of legal recourse. They couldn't easily sue in U.S. courts. The Venezuelan government offered no protection. U.S. receivers had no jurisdiction over Antiguan assets. The pattern repeated across Colombia, Ecuador, Mexico, and Peru. In each country, Stanford's local advisor network, licensed financial professionals recommending his CDs as a premium product, had no knowledge of the fraud. They had visited the offices. They had seen the bank. When the fraud collapsed, they faced the same losses as their clients, plus professional exposure for the recommendation. According to Senate Banking Committee testimony in 2012, approximately 70% of Stanford's total investor base was concentrated in Latin America. The fraud's center of gravity was the offshore savings of people trying to protect their money from the instability of their own countries. Court-appointed receiver Ralph Janvey was tasked with identifying, seizing, and liquidating every recoverable asset. Stanford's real estate spanned Antigua, the U.S., and multiple other jurisdictions. Each property required appraisal, title review, sometimes litigation. The Sir Vivian Richards Stadium, built with investor money, was not recoverable. The Antiguan government retained control of it. Investors received nothing from it. As of Janvey's most recent court filings, the recovery has returned approximately $500 million to claimants, against $7.2 billion in losses. For most Stanford investors, the money is gone. Alan Stanford was convicted on 13 of 14 counts of wire fraud, mail fraud, obstruction, and money laundering in a Houston federal courtroom on March 6, 2012. He was sentenced to 110 years in federal prison. He is currently incarcerated at the United States Penitentiary in Coleman, Florida. He is 74 years old. James Davis, Stanford's CFO, who had managed the internal books, pleaded guilty in 2009, cooperated with prosecutors, and was sentenced to 5 years. Leroy King, the Antiguan regulator who allegedly accepted payments from Stanford, pleaded guilty in 2019 and was sentenced to 3 years. The SEC's failure was the subject of Senate Banking Committee hearings in April 2012. The committee's examination was pointed. Multiple investigators, across multiple years, had identified credible evidence of fraud. Multiple escalation opportunities had been missed or blocked. In the aftermath of both Stanford and Madoff, two of the largest Ponzi schemes in history, both missed by the same regulatory agency, the SEC overhauled its procedures for handling fraud reports. Under the Dodd-Frank Act of 2010, a formal whistleblower program was established, creating financial incentives for individuals to report fraud directly, bypassing the internal processes that had failed in both cases. Whether those reforms are sufficient remains debated. The Stanford fraud is easy to understand as a story about one man, a con man, a criminal, a thief. That framing is accurate, but it is incomplete. Because what Stanford built was not a fantasy held together by charisma. It was a system with identifiable components, an architecture that can be named. Rules that appear, with variation, in large-scale real estate fraud consistently enough to be worth stating clearly. Rule 1. Build physical assets using the money you've taken. Real buildings, real land, real infrastructure. Stanford built a bank building, a stadium, and offices in 29 states. None of these were financial investments in the traditional sense. They were evidence. Physical, visitable, photographable evidence that the operation was real. You cannot fake a building. You have to construct it. And construction requires real money, which means Stanford had to spend investor funds on the very apparatus that convinced investors their funds were safe. The money that was supposed to be invested was spent on demonstrating that it was being invested. This is the fundamental irony at the center of every real estate-backed fraud. Rule 2. Keep the assets illiquid. Real estate cannot be liquidated overnight. This is not incidental. Stanford's CFO testified, under oath, in federal court, that Stanford had deliberately allocated funds to illiquid assets knowing that regulators could not quickly convert them to cash. Every dollar locked in a Caribbean property was a dollar that extended the scheme's survival time. Real estate was not a hiding place for the fraud. It was a time-buying mechanism, built into the structure on purpose. Rule 3. Build the offshore structure before you need it. Stanford's decision to locate his bank in Antigua, rather than operating a U.S. institution, was not a tax decision. It was a jurisdiction decision. U.S. regulators could not directly examine Stanford International Bank. They had to request cooperation from Antiguan authorities. Those Antiguan authorities had allegedly been receiving payments to be uncooperative. This jurisdictional structure created a gap between what regulators could suspect and what they could prove. For 12 years, that gap was enough. The lesson is structural, not specific to Antigua. Any financial product whose primary regulatory guarantee depends on an offshore authority warrants specific and heightened scrutiny. Not because all offshore banking is fraud, because the jurisdictional gap is a deliberate feature of schemes like this, not a coincidence. Rule 4. Target people whose circumstances make the pitch hardest to refuse. Stanford's core investor base, particularly in Latin America, consisted of people who genuinely needed a safe, dollar-denominated offshore account. Venezuelan currency controls were real. Political instability was real. The threat to domestic savings was real. Stanford offered a real-seeming solution to a real problem. This is not victim blaming. It is an observation about how targeted fraud works. The fraudster does not pick the most credulous target. The fraudster picks the target whose circumstances make the product hardest to turn down, and whose need for it to be real makes them more likely to accept evidence of legitimacy and less likely to probe for evidence of fraud. None of these rules were invented by Stanford. The Bernie Madoff scheme ran for decades because his legitimate trading operation, the SEC registration, the industry relationships, answered the due diligence question before it was asked. The savings and loan crisis of the 1980s involved hundreds of thrift institutions using depositor money to fund real estate projects whose inflated valuations were used to justify returns the underlying assets could never support. The scale changes, the geography changes, the product changes, the rules do not. Here is the single most transferable lesson from this case. When someone is selling you a financial product, and the primary evidence of its legitimacy is something physical, a building, an office, a headquarters, a stadium, that is not evidence. That is marketing. Evidence is who regulates this and in what jurisdiction, who audits this independently with full access. What is the exact mechanism by which my returns are generated? What happens to my money if I want it back tomorrow? Physical assets answer none of those questions. They are designed to make you feel that you don't need to ask them. Next time on the Realty Files. A coal mine fire in Centralia, Pennsylvania has been burning underground since 1962. It has never been extinguished. The ground above it cracks and subsides. Roads split open. Toxic gases vent through the soil at temperatures approaching 1,000 degrees. The federal government began buying out residents and demolishing homes in the 1980s. Pennsylvania revoked the town's zip code in 2002. The town, legally, no longer exists, but a small number of people refuse to leave. They are still there. Episode 4. The Town That Burned From Below. This is the Realty Files. If this episode gave you something to think about, like it, share it, and subscribe. Every episode on this channel is built the same way. Real cases, real documents, real consequences, no hype, no filler, just the full story. We'll see you in the next one.